So the biggest problem we see for the Australian economy is that there's all these tools you can use. After you've had a big downturn, there's a number of tools you can use to bring yourself back out of it. And if you've had your housing market has been smashed and you've lost a lot of value and people are unsure, there's a lot of different ways you can use to get that housing market moving again and get the rest of the economy moving. We've done a lot of those just to keep the housing market where it was, just to try and keep it at a high level. You know, we've brought forward all this demand from first home buyers by doing 95% guarantees, 95% guarantees, and stamp duty reductions and all those types of things we did last year and the year before, trying to keep the prices where they were. Rate cuts. You know, we're obviously we've hit this with basically two bullets in the barrel, and we've shot both of them now. There's in terms of stimulus, Matt, for me, the stimulus at the moment, I'm pretty sure the government will come back with another stimulus package, and we'll see how that goes when it comes out. But for me, the stimulus package they put out the first time was just badly targeted in terms of it being, what you want to do is you want to get as many people voluntarily quarantining themselves as you can. Whereas the message seemed to be, here's $750, please go out and spend it at the shops, keep everything going, which is like, no. We want everyone at home, quarantine for a bit. Once we're over, now we want to start pushing stimulus into the economy to get people out and shopping and doing things they used to do once the whole virus has passed. And so until we start seeing some changes on that, again, I feel as if it hasn't been well targeted, and so we're not, we don't think Australia is particularly well positioned to come out of this any stronger than anyone else. Plus you add then world demand. So Australia is very commodity centric, obviously, and we need to, yes, we'll probably see more stimulus in China, but China was already building a massive amount, almost 3 times as much as what they're building sort of in 2007, 2008. So there's a certain limit as to how much more they can spend. But secondly, you're going to have demand hits from the rest of the world as well. So while China might come back with some more stimulus, there's a limit to how much they can stimulate. And if you lost demand from North America and you've lost demand from Europe and all these other big centres, then it's hard to see where commodity prices are going to be particularly strong over that period. We'd sort of made a decision quite early on that the signs we're seeing out of China, especially in terms of shutdowns, were going to cause issues, just as supply chain disruptions and problems for companies. Now, companies go through this cycle. As you go through an economic cycle, company debt rises over it, and you hit a certain point, and then you get a recession, and something tips it usually at that point, and then you're down to the next, it all crashes down, and then you start your next cycle. And so we've seen that pretty much every recession for the last 30, 40 years. You just get that same cycle. Corporate debt was at record highs in the US as a relative to GDP. So many people were talking about this, saying, end of the cycle, we're almost there, we've got a little bit longer to go, but we don't know what it is. And so for us, that was like, well, why couldn't it be coronavirus? And that was where we sort of started with the whole, just a minute, this is like a major effect on supply chains, demand, it's all these other factors. That to us was the process to say, well, we need to move out of equities, we need to move into cash, we need to move into bonds, we need to move into foreign currencies to sort of lever that for our client portfolios. We knew we were at the end of the cycle, and everyone knew we were at the end of the cycle. That's all we ever read, was people talking about end of cycle, and then just putting 2 and 2 together to say, here's an event that you could really hold up to say this was the end of the cycle, and that's what's going to tip Aussie equities. So Aussie equities at the time were trading on almost 19 times earnings. And they usually trade, so not 19 times price to earnings ratio for anyone who's not, and that's about 30% higher than what we usually see on average. So for us, we're looking at the market going, there's no growth. We think there's a demand shock coming from China, big or small, but they'd already shut down a whole bunch of China. There's a supply shock coming from China. The market's 30% overvalued versus its average, so it's looking for growth. Growth had already stalled. We weren't seeing any earnings growth. Why would we want to own equities at this point of the cycle? Like it was a no-brainer to tip out. So the first 30% for us was just saying, well, just if earnings didn't change at all, which is a heroic assumption, you could fall 30% and just be average. And so that's where we're sort of sitting at now, going, okay, we've fallen 30%. We're back to maybe a little bit below average in terms of valuation, but that's before we started factoring the earnings hit. And you're going to get an earnings hit, and so we're willing just to step out of the way. And on top of that, Australia versus the world, so we invest in both global and Australian equities. was almost as expensive as the US at a raw level. But Australia is chock-a-block full of banks and it's chock-a-block full of resources. And these are stocks that should trade cheaper because they're not, banks are very volatile, highly geared, and resources are, again, their earnings are extremely volatile. And so they almost always trade on lower multiples. So what we would do is we would say, well, let's just separate every sector out. So we take the Australian resources companies compared to international resources companies, take the Australian telcos compared to international telcos, take the Australian retail sector. Every single Australian sector was more expensive than their international than the US sector, except for one, which was the retail. And then if you stripped Amazon out of that, then Australia was more expensive than all the US retailers. So for us, Australia has been very expensive. 30% brings us back to levels that you'd sort of say, well, in a normal growth environment, I'd be talking about buying, and do I reweight to Australia, especially with a currency that's come down so far. For us now, it's about saying, well, we need to get a better guide on what's really happening on the earnings front and looking at which companies will survive. Because that's the biggest thing you're trying to find now is there's lots of companies out there that are very cheap, but there's probably companies out there that just won't survive because they have a debt burden that's too high, and a couple of months cut off from their revenues is going to send them under. We've seen the RBA step in and help the bond market. So we've been seeing government bond yields, after initially falling quite significantly, rising in the last few days, which we think is that some traders who have got risk parity, we think that's deleveraging their portfolios. So basically they're just selling everything that's liquid. And you've seen that in the gold market. So you've seen gold, you've seen and government bonds, which should be the highest. Some of the flight to safety assets have been falling, but we think that's just people who are deleveraging and selling everything. So that's sort of the first stage. So seeing central banks get a hold of that market is one key thing. Actually seeing the corporate debt market open up again is the next one. So corporate debt markets are pretty much closed and certainly not looking like they're getting any better. So we're going to see corporate defaults there. And I think as well, what's lost in some of this is the fall has been so quick and so dramatic that we're sort of having conversations now that ordinarily, like in the financial crisis, you would have had 12 months or 15 months into it. You're like, right, here's the things that's happening, and this has been falling, and that's, these markets are closed, and and companies are going broke, and now we can start thinking about where the other side is. We're 3 weeks in. Like it's not like it's been forever, and we're like, well, when's the time to try and catch this falling knife? For us, it's about saying, no, until we can see corporate debt markets open, you're just not even thinking about, because we want to see the financial system back and going again. There's obviously certain levels where you go, well, at these prices, we'll take whatever, we'll take it, but we're not there. We're still we're still sort of back to a little bit under average on a long-term basis, assuming that earnings are fine. And there's so many companies just pulling earnings that it's very hard to get a read on it. We make our own estimates, but again, it's our faith in our own estimates is very low because companies obviously don't know what's going to happen. So trying to get a feel for how bad it is. And I think there's a certain part where we sort of feel as if when you're in front of the wave and you've sort of you've got a little bit more time to relax and go, well, if we miss a little bit of the bounce, then we're not as concerned. I think there's probably people who are fully invested or had invested trying to catch the falling knife on the way down, and that's always a much harder decision for them because they're like, well, if it bounces now, I'll miss out on the. I'm already behind, and so if I miss the bounce, then I'm going to get back. Whereas I think our clients are all in the position where we've saved a lot of money so far, and if we miss the bottom, 5-10%, we're not too concerned, but we're happier if we want to be certain. So so the first part was central banks, second part was corporate bonds, and then getting a read on how long this is going to last for. It looks, based on some of the Chinese experience, that 2 to 3 months, you're probably hitting towards the end of it, but they've done some pretty strict lockdowns over there, and so we actually think that if you don't do as strict lockdowns, it's probably even going to be faster than that because it'll burn through your population quickly. You'll have a lot more people dead and your hospital system's going to be trashed, but it probably will be a little bit faster. So you want to try and, that's your best case, probably more likely to be closer to 6 months. And so getting a feel for how much damage gets done there, which companies actually do survive, which ones have gone broke, how much governments bail out companies and how much they don't. And there's this huge moral hazard issue that's coming up for central banks and for governments now about saying, well, who do I bail out and who don't I? and you definitely don't want it to be the squeakiest wheels and the people who have the closest relationships with governments. Chances are that's probably who it will be. But it'd be nice to see them come back with a list of, right, we're looking for systematically important people, or whatever it is, and we're not just giving you the money, we're taking debt or we're taking equity or whatever it is, so that governments actually have a. You saw what they did with, say, AIGs or some of the banks during the financial crisis, where they did take debt positions or equity positions, and after all was said and done, they actually hadn't lost much money or any in some of the cases, and made a profit. So as long as you see governments doing that type of behaviour, that will be another positive, as opposed to sort of blanket, we'll just bail out. We were joking before about casinos are asking for bailouts, and you're like, well, since when was a casino a critical industry for the rest of society type thing? So it's making sure that seeing what governments do in terms of that, because if you do end up with bailouts for everyone, or certainly non-systematically important things like casinos, it sort of means there's less money to go around to people who actually need it. So very much just now trying to gauge the reaction. The types of assets we are buying, that's probably the most, the next question everyone always wants. So it is a mixture of working out which cash positions are in, but the Aussie dollar's come down so quickly, it's been a great hedge for all our positions. We looked at sort of 55 cents as being, that was sort of like our throwaway line. When it gets to 50, once the stock market falls to 30% and the Aussie dollar's back at 55, wake us up and we're like, oh, that was 3 weeks. That was quick. Now we've actually got to start doing a bit more on that front. The bond side, we've still got some holdings in bonds, and so we still think that we think central banks will get control of the bonds at that long end of the curve. But again, you're not going to make bucket loads of money in those, but it's more about protecting the rest of your portfolio. And then as the further we go on and the cheaper equities get, we then look to buy. And we do have equity portfolios. We've got some fully invested ones that we sort of always have for people who've just come to us just for international or just for Australian equities. And in those ones, we're trying to up the quality. So the good thing about when markets go through these dislocations is you do get pricing anomalies. And you'll get one stock come out with a profit warning and fall 20, 30%. And there's a similar stock in the same industry, you can see is going to have the same effect. And if you happen to own the first one, you get a chance to flip out of that one and back into if you own the second one, that hasn't yet reported, you can flip into the one that has fallen and things like that, and just up the quality generally of the portfolio in terms of saying this is their time to say, can we find very cheap stocks at a discount to what they would ordinarily trade at, and more importantly, for us though, it's a relative game about how can we improve the overall quality of our portfolio at the right price. There's certainly the travel sector is going to be smashed, and it's not going to come back quickly, but there are stocks that are just going to be priced so low that you have to sort of take advantage of those. In some cases, you might be buying back from receivers, I guess, or buying back from the government, the stocks that might have been nationalised or whatever. So travel's one big area. Oil's a bit of a. We can spend another podcast talking oil. I think that's one for us that we've been keen to stay out of. And I think there's definitely a short-term trade in it, but I think that's one which we wouldn't be sort of buying on a 5-year or 10-year view. But there's and one of the issues going on in that sector at the moment is even though you will have bankruptcies, if you have a bankruptcy and somebody's got an oil well, it's not like they turn up and turn everything off and when you're done, there's all this extra, like the bankruptcy then the debt holder then steps in and says, well, it is very cheap. They've already spent the money to dig the well. Actually, the actual operation's very cheap. I may as well keep going because I'd prefer to get something out of this rather than nothing. And so, we think oil might be a bit longer to overcome. So I wouldn't rush straight back into oil. Other sectors, and then I think we need to be quite selective about being consumer discretionary. Our view is that you're not going to rush out of being in quarantine for 2 or 3 months and suddenly decide, hey, I need a new car, or I suddenly need that Louis Vuitton handbag that I've been eyeing off. I think you'll find people will be quite circumspect about what they're spending, and I think you'll find there will be this real pullback. We're looking for companies that we were already looking for these companies based on the trade war that will benefit as the supply chains move out of China. And so whether it be companies that are involved in setting up new facilities and managing those types of factors, or whether it's companies that are involved in that used to have quite large competition with some of the Chinese companies. Because we expect this will create a huge acceleration away from supply chains in China. That was already happening because of the trade war and other factors. But we just think that there'll be so many people who will now go, well, I had 100% of it in there. I knew I wanted to move it back to 75%. Actually, you know what? I'll make it 33% left in China, and I'll spread the rest out in a few different countries, or bring it all back to my home country. So people that are going to benefit from those types of ones are some of the sectors we're looking at. Banks, in a very simple sense, borrow from people on a short-term basis and lend out to people on a long-term basis. And so they make money. There's what you call a steep yield curve. If I can borrow very cheaply and lend out more expensively, then a bank can make a lot of money. Now, it doesn't really matter where interest rates are. You know, they can be 15%, but as long as they're getting a decent mix between those, the banks will be quite profitable. The problem as you get closer to zero is banks get to the stage where they stop paying money on transaction accounts, and that happened for most people years ago. But gradually they can't go any lower in terms of the amount the interest rates they're paying people who they're getting it through. So that's on one side of the ledger, and the other part is how flat the yield curve is, which they don't really have much control over. But the issue is when interest rates start hitting zero, the yield curves start getting very flat. And so banks just aren't profitable, or not very profitable, and they're just not incentivized to get out and lend on that basis. And so we've seen that through Europe for the last 5 or 6 years. Their problem there is they're trying to hold their yield curve down as far as they can to get people out lending, but the banks don't want to lend. So they've got to keep it enough that they can try and get their banks, they're trying to get enough incentive for banks to try and to get out and lend without, and keeping them alive. You don't want them to go broke because now there's a flat yield curve and your banks don't want to lend. And we just think that's where Australia's going to be, is stuck in that same limbo of how do we keep the interest rate so low that other companies can actually borrow and want to get out and invest without ending up in the position that our banks are going broke because they can't make it. So we don't think I think what did we title it? We just said bank yields bank dividend yields are unbelievable, but not in a good way, because it's that thought that you're looking at the numbers and we know they're going to get cut, and the analysts have them coming off in terms of the cuts, but we don't think they've got enough in terms of cuts. And if we run into problems with unemployment, which we think's quite likely, and the housing market, which again is in this type of scenario is highly likely, then the banks could be in real trouble in terms of they're a highly leveraged play on the Australian economy. And if the Australian economy, houses and mining are both coming off at the same time, then it's not good for banks. We've had a government that's come out and we had a Royal Commission say irresponsible lending, and then we've had a government come out shortly afterwards and say you guys have to get out and lend as much as you can. And that was that caused the first fall in housing prices, and then the housing price rebounded once the government said no, we need you to lend as much as you can. Now the issue was, for me, is that from 2012 to 2017 we had exactly the same financial conditions in Western Australia as what we did in Eastern Australia in terms of interest rates and willingness for banks to lend as much as they could. Perth properties prices fell during that period because their unemployment rate went up by 1.5–2%. So if unemployment ticks up in the eastern states and we can't come up with a reason for it not to, then we think we're in the same situation, is that there's a trapdoor below house prices at some stages. Because once unemployment starts rising, people will sell not because they want to sell, but because they just can't afford to be in the house. They don't have a job. There's no prospect of them getting a job because the economy is in shutdown, and you'll start seeing forced sales. So the best case is that government throw stimulus and do whatever, and we've used up all the good answers, the good solutions to the housing market. So now comes the bad ones. I don't know what we've got, but we do have a low government debt relative to the rest of the world. So maybe we'll throw a bunch trying to prop the housing market up. So that's your best scenario for the housing market, is government step in and do stuff that I can't imagine what it'll be, but I'm sure they've got good imaginations and they've thought about this a lot. How can we keep house prices high? The worst case is, well, the US had a housing crash in 2007, not because the government wanted them to have a housing crash, and not because they weren't trying to keep the whole thing as high as they could. So did Spain, so did Ireland, so did most countries that have had housing crashes. It's not because the government suddenly decided, no, we're going to, we don't want to try and bail these guys out, and we don't want to try and help with all these factors. So we think if unemployment really gets going in Australia, and if you don't get the right stimulus measures, or even if you get some stimulus measures that aren't effective, which is probably more likely, is that there's decent downside in houses. How far? Look, it's very hard to tell because it depends upon all these other actions that other people put in. We think, though, again, similar to where we're saying, look, equities could fall 30% to bring them back to their averages. We look at houses from a few different ways. I'm going to leave the investment part aside because that's, from an investment point of view, an investment in houses only makes sense if you think the price is going up, because it certainly doesn't make sense from a rental yield perspective. But the two bigger factors for us, in terms of, because houses are different, people have to live in them, is saying what are house prices doing relative to wages? So, sorry, what are mortgage payments doing relative to wages? So can people afford to pay the mortgage payments? Now, wages we don't think are going anywhere over the next little while. There's going to be huge unemployment, and shutdowns are going to cause lots of issues there. So we think wages are pretty flat. Mortgage rates can't go any lower. We've just had the last cut today, so you're done in terms of that. So to fall back to an average, you could probably knock 20% off house prices just to bring that back to average. The other one is housing prices to rents as well. Mortgage payments to rents. So that's the other one about saying, so one is, can people afford to live in houses? And the other one is, what are their options? Because Sydney, for example, seems to top out about 200% of that. So if it's twice as expensive to buy a house as what it is to rent, that seems to stop people from wanting to do it. And when it gets to about 100% in Sydney, that's when people start to go, okay, well, if it's going to cost me the same to have a mortgage as what it is to rent, then I'll start buying. And so at the moment we're about 160%. So that sort of says you could fall 30%-ish, and before you'd bring back to sort of the lower bounds. So the lower bounds are a fair way down. And keep in mind as well, for most people, they don't own the houses outright, and so a 20% fall in houses or 30% fall in houses would mean 100% fall in the equity you have in it. So so the downside is pretty bad. The upside we think is pretty limited, and it would really require a lot of government intervention to get there. The types of things we'd be looking at is Aussie equities. Absolutely, we'll be looking for the rise off the bottom and what we can pick out in terms of those. For international, we will do some international, but the idea for that was we'll probably be hedged on that, depending upon, at the moment, certainly where the Aussie dollar ends up. It's 55 at the moment. If things keep going the way and we do get a housing crash or whatever, quite possibly it'll end up a bit lower. And we'd be looking to try and hedge some of that, depending upon outlooks for different countries and other things. And we'd be looking to try and get into those discretionary sectors. The sectors are going to give you the most on the way up. Having said that, though, it'll be we're very much quality and value. So we run this. We run a quality score for every company and a value score for every company, and we try and buy stuff what we call it under the curve. So we want a mixture of both. But what it means is we can buy something that's average quality stock, but really, really cheap. We're happy to buy it. And then if it goes up too much, we then have to sell it. And whereas a quality stock we can own till it gets a little bit expensive. And so for us, it's still going to be a matter of saying, chasing those quality value stocks and where we can get that right mix. That's probably not the stocks that are going to go up the most. The stocks that are going to go up the most are probably the ones that aren't very high quality. And you find that the ones with the most debt that are a touch and go as to whether they survive or not, they're the ones that are actually going to go up the most. They're the ones you're going to, your hero, fell 90%, rose, 100% off the bottom. They're the ones where you get the most, but that's not really our play space. Yeah. And it is the other thing to keep in mind as well as you're trying to pick the bottom is that, there's a saying out there about a stock that's down 90% is a stock that was down 80% and then it halved. Is that the ratios, and it's a maths joke for that type of thing, but the ratios don't add up the same way. Once the market's fallen 50%, if it's going to fall 60%, that's actually a 20% fall from where you were. So although it seems like not much of a difference from where you started, at the time it's going to seem like a big difference because you've just had a 50% fall. If it's going to fall 60%, that's a massive, that's knocking another 20% off your already depleted earnings. So trying to find that bottom, we're happier to miss that bottom 5-10% and be a bit more certain and sort of pick it up on the way up.